Good afternoon, everyone. Thank you so much for joining us for today's webinar. My name is Caitlin Russell with the International Franchise Association, and we're excited to continue our fall labor and hiring series today. Just a reminder for those, if this is the first time you're joining one of the series webinars, the series is in response to concerns we have had from IFA members relating to pressures and problems with hiring. As we step back and research the problem, we discovered the labor shortage is not just one problem, but a series of problems and concerns. So today's presentation, titled Economics of Hiring, we'll hear from John Leer, Chief Economist with Morning Consult, who is a global data intelligence company. He's going to discuss the Delta's variant, acute, yet temporary impact on customer confidence and employment, provide insight into the future of customer spending, the demand for labor, and job search activity. So we're really going to get into the data of all the hiring stuff. So it's going to be very, very interesting content. Two quick notes before I do pass it to John. We are recording today's webinar. It will be made available for IFA members on community.franchise.org. And then if you have any questions for John, please put it into the questions box and we'll address them at the end. All right, so I'd like to now formally welcome John. John, go for it.
Thank you so much, Caitlin. Yeah, I'm really excited to be here. There's a lot to cover. I'm going to throw a lot of data out there because, because we're a data company, and so we always have data that's relevant to the question at hand. This particular presentation is really focusing on what I'm sure is present in the minds of many of your members, which is the sort of chronic labor shortages that we see reported in the news all the time. Why is that the case? What's preventing workers from looking for work or accepting positions, and how long is this all supposed to last? And so I'm going to motivate this sort of presentation. Oh, here's a nice little bio of me. As Caitlin said, I'm the Chief Economist here at Morning Consult. I'm going to motivate this presentation by some publicly available data that everyone here in theory could access, and then I'll bring in a lot of Morning Consult's proprietary data to try to shed light on these problems. So the question facing a lot of businesses right now is, why are there so many job openings? You know, in theory, people are not working. They should be going out looking for work, accepting positions, given their need to pay their bills and make their payments, but they're not. And on top of that, we see a growing share of workers quit their jobs, and that as a share of total separations from employers, quits accounts for a growing share of that total. And so there's something going on here. There's something different about the way that the pandemic is driving workers' decisions to both look for work and accept positions. And so that's sort of the high level discussion point, and then we're going to dive in and try to understand what's going on. So the first, I'm basically going to sort of cover this in three parts. So the first part is understanding from the perspective of workers trying to understand where they're likely to find jobs. It's looking at the flip side and figuring out, well, where is their demand for certain goods and services? How has that changed over the course of the pandemic? And what sort of signal then does that provide to people looking for work that allows them to know where those jobs exist? So that's part of it. And then I'll dive in and talk about the permanence of the impact of the Delta variant, or I should say the lack of permanence, the rather temporary impact of Delta on employment. And then I'll wind it down by talking about job switching and wage expectations, which is really sort of a unique feature, I think, of this particular recession and the pandemic. So if I just start off and sort of level set here, one of the easiest ways for me to understand where we are in this particular pandemic is looking at this daily consumer confidence data that we collect at Morning Consult. So as all of these events have occurred over the course of the last 18 months, whether they be increases in cases, policy interventions, elections, consumers have responded to those events in different ways, and that impact of let's say policy interventions has changed over time. Where we are currently is interesting. I mean, clearly we see that if you go to the right-hand side of the screen, clearly the Delta variant was top of mind for consumers, but it's not nearly as dramatic as the fall in confidence that occurred earlier in the year. So if I go then here to this next slide and we just sort of chart that out and look at, well, how is the pandemic affecting consumer confidence? we see this very clear sort of what I'm calling an asymmetrical relationship. So as cases in the blue line here increases, that tends to drive down confidence, but the inverse isn't necessarily true. So if we're over here in September, we see that cases are falling fairly rapidly, and yet confidence isn't rebounding. And that's similar to what we've seen historically, and then also across all the countries where we collect data. And it's that the fall in cases allows consumers to then focus on the underlying economic reality, which may not be particularly strong. And so then if we look at the change in confidence over time, and I'll show you on the next slide why that's the right way to look at it, the change in confidence over time, we see very clearly that the impact of case surges or case counts on consumer confidence has decreased over time. So we had this first wave, a massive wave, confidence fell by over 30% in a very short period of time. Then we had a dramatic recovery led by those high income consumers, the so-called K-shaped recovery, some moderate period of stability, and then we had a second wave, November and December of 2020. Again, confidence fell, but this time only by 7.4%. And then we had the Delta variant, which began, let's say, we started seeing in our data the first week of July, and there it only fell 6.8% from peak to trough. And so there's a sort of diminishing impact of COVID cases on consumer confidence. Now, again, why is the change in confidence the right way to look at it? And that's where I've turned to some of the folks who are at the Chicago Fed, and they're using our data to help them nowcast in real time retail sales. And they use, again, that change in confidence over time to show that that we've had a sort of a high level of volatility in retail sales early on. As we saw in that prior slide, it dropped dramatically, it rebounded sharply. We had this crazy bounce back. There's been a relative period of stability, and that at this point in time, we continue to see sort of very slow but persistent growth in consumer spending. So that all tells you something about aggregate demand. Aggregate, in this case, it's aggregate demand for goods, but workers and companies, as everyone on this call knows, companies hire workers based on the demand that they both experience real time and also what they're expecting to occur in the future. And so what this tells us is that going forward, we should expect to see the impact of cases have a diminishing impact on consumer demand. It's not to say, however, right, that this is all one, that we're going to bounce back and go back to, let's say, a pre-pandemic level of spending. We live in a very large country that has different regions experience this shock differently. We see here in this regional breakout that folks in the Pacific and Mid-Atlantic and mountain regions have bounced back faster than some of the other divisions. And so from the perspective of workers, what does that say? Well, it tells them something about a realization that we're still in the middle of a pretty tumultuous period of time, that the dust hasn't fully settled, so to speak, that while we see the aggregate level of retail spending return to where it was before, which in theory is going to signal that there's a lot of demand for labor, that we're selling goods and that we need people in stores and in businesses to sell those goods, it's not clear yet which region is going to come out on top and whether or not people who live in a particular region maybe are going to have to move. And so as you start thinking about workers being forced to make a commitment to a particular company, this information sheds light on the sort of uncertainties that they're facing. So in particular, if you think about geographic uncertainties and whether or not they live in a region where jobs not only are currently plentiful, but where they will continue to be plentiful going forward. Now, I think this comes from our weekly comfort tracker, where we're tracking how comfortable people are engaging in a range of sort of standard activities. And this particular one is looking at going out to a restaurant or cafe. And I think what it tells us is two things. First of all, clearly consumers are growing increasingly comfortable going out to a cafe. And here, yet again, if you look at this sort of June period, that the The trough that you see in the data on the right-hand side of the screen is not nearly as severe as what occurred in September, November. We had really positive gains as people have grown vaccinated. So that's all really good news. But when we dive in and look at some of our spending data and try to understand, okay, people are going to feel comfortable doing things, but does that mean necessarily that life in a post-pandemic world is going to exactly mirror what it looked like prior to the pandemic? We don't think that's the case. In particular, we're starting to see that increasingly people are moving away from driving and going back into public transportation. So as gas prices rise, people are returning to the office at least a couple days a week. They're doing some sort of commuting. We're seeing that people are reallocating some of their spending away from gas and car payments and towards public transportation. Again, this is just another sign that if you're a worker, let's say, why does this matter? Well, this matters if you're trying to decide if it's better for you to go work in the suburbs, where historically people have been hanging out there for the last 18 months because nobody was coming into cities, or is it better to go back and start looking at that job maybe they used to have where they were working in a restaurant that supported people who were commuting on a daily basis into an urban area. And again, I just bring this up to highlight the sort of level of uncertainty that we have a pretty good sense of where we're headed, but the dust hasn't fully settled yet. A theme I'll reiterate going forward. So this is the last point to just drive this home yet again, which is that we see that people increasingly are going in to go grocery shopping, that the Delta variant had some impact on that in July in particular, folks cut back and they said, wait, maybe we shouldn't go in person to go grocery shopping. But in fact, that bounced back really sharply. And so there's something about, this living in this pandemic world where we're, a growing share of the population is vaccinated, that's allowing people to feel comfortable shopping in person now, and maybe they're not. And what we see in our data is that they are in fact not ordering groceries online to the same extent as they were in February, March, prior to a lot of the widespread vaccinations. And so again, we're moving out of this crazy pandemic world. We know that the future is going to be some sort of mixture of some of the trends that we experienced during the pandemic, and then of course some of those the pre-pandemic normal. But from the perspective of a worker trying to figure out how exactly they're going to be able to optimize their long-term earnings, I think a lot of that remains unclear. And so now I'm going to sort of switch gears a little bit. So if that's focused there on I focus on the demand for goods and implicitly then the demand for labor. What do we see in terms of the direct impact of the pandemic and the Delta variant in particular on labor and on employment? Every week we're tracking, we ask 20,000 people, and we've done this since the start of the pandemic, did you lose pay or income at any point over the course of the last week? And in general, that series follows very closely the unemployment claims numbers. The periods where it diverges, you can see the two here, is where there's a fairly significant policy shift. And so in a world where everyone's getting $600 benefits, all the people who lose pay or income end up filing claims. In a world where people no longer are receiving those benefits, there are a lot of people who are not filing for claims. And so as we go and look and compare these, again, the sort of initial impact of the pandemic on lost pay and income, this middle period where we have a significant second wave, and then the most recent Delta variant, very clearly the employment impact has moderated over time. We continue to believe that the impact of the Delta variant was more severe than what you would see in unemployment insurance claims, and I think that the September jobs report bared that out. But the important part is putting imagining that you're a worker trying to figure out whether or not you should go in and start looking for work. And for all of these people who've been laid off or had some of their salary or pay cut in some way, think about the network of the friends, the coworkers, the neighbors who hear this story. Oh, wait, maybe this red hot job market isn't as robust as we thought it was. And I think that that's something maybe that it's lost on a lot of people, that unemployment claims and in morning consult data, lost pay and income remain elevated. We continue to see 300,000 people every week filing for unemployment claims. That's a high number, and I think that's a function of this crazy level of volatility and of uncertainty that we experienced over the last year. And workers and companies are trying to find great matches. You know, in the literature they call this search and matching friction. So there's a lot of workers out there who've maybe taken a job that wasn't right for them, or there are companies who've hired people who didn't really have exactly the skills that they needed. And so there's a lot of friction there as companies and workers really try to find solid, sustainable matches. And that's what we see in this data. And then when we go look at this at the industry level, I think it becomes even clearer. So here in the blue and teal lines, we're showing leisure and hospitality and food and beverage. Over the course of the pandemic, workers in those industries have experienced elevated levels of pay and income losses. But what's really encouraging is the extent to which the pay and income losses experienced following the surge in Delta-driven cases was so much lower than what we saw during the second outbreak and the first. And so again, that tells you a lot about, you know, having existing workforces in these industries that are a little bit leaner than they were in January of 2020, that the workers who are there are clearly, you know, they've been justified as being needed, as being you know, to use a sort of a technical term, to providing a strong marginal benefit to relative to their costs. And unlike those prior two periods, we didn't see these crazy spikes in pay and income losses in those particular industries. And again, that has something to do with the vaccination. It has something to do with companies and consumers feeling more comfortable operating in this type of world. And I think going forward, it says a lot about you know, this provides a really strong signal to all of these workers who are thinking of coming back into the leisure and hospitality industry or the food and beverage industry. And it's a signal to them that if they go in and sign up for this type of a job, they're less likely to be fired the next time there's a strong increase in cases. And I think that's kind of in a nutshell, the message that I'm trying to highlight here is that signing up for a job and structuring your life around a particular job where you feel fairly certain that you're going to end up losing that job in a matter of months is a really difficult decision for workers to make. And I think that as companies do a better job of retaining workers over the course of, you know, when there are case counts that escalate, provides a really strong signal to all the workers sitting on the sidelines thinking about coming in and starting to apply for work. And in fact, as it so happens, this is what we see in the data. So from left to right, we have, this is all sort of proprietary Morning Consult data. On the left-hand side, we have our unemployment rate, which looks at the share of workers who are not working, but they are actively looking for work. We have our employment to population ratio, just the total share of workers taking our surveys, 200,000 surveys every month, 6,000 a day in the US. The share of workers who are actually working for pay or profit, we've seen that tick up pretty dramatically, and I think we will continue to see both in October and going forward that the jobs report will reflect a lot of those numbers. And then the really encouraging sign is on the right-hand side, where we're starting to see more and more workers come back in and start looking for work. Again, they're looking around, they've got friends in the food and beverage industry, the leisure and hospitality industry. Those friends aren't experiencing job losses this most recent time during the Delta surge, and as a result, they're saying, "Yeah, let me throw in my hat and see if I can go find a job." I think something that is interesting is that more generally, what we don't see is you know, vaccinations necessarily providing a clear jump in global labor force participation. So I think it's an important, necessary feature to this jobs recovery, but it's in of itself is not sufficient, and in large part because certain vaccinations, of course, are more have a higher efficacy rates. I just wanted to highlight here that, you know, that the increase in jobs that we've seen recently, starting, let's say, in late August, early September, have really been driven by low-income workers, people who are living in households that on an annual basis make under $50,000 per year. And I think what's also exciting, and I would imagine for the franchise group, this is particularly relevant, is that we see a growing share of part-time workers, people who are working under 35 hours per week, saying that they in fact want to work more. And I think what's really interesting is we've been asking them for the last, last 18 months, why is it that they don't want to work? Among those people who don't want to work, and again, I just highlighted it's a shrinking share of the total part-time labor force, but why is it they don't want to work? And we don't see, so childcare obligations has continually sort of fallen as a reason why people are citing a lack of a desire to work full-time. And then, but family and personal obligations and health and medical limitations have essentially remained stable over the course of this pandemic. So if you can imagine, a lot of people who are working part-time are also being counted on to handle the family responsibilities. And this is something, again, we'll talk about this later on in the presentation, about how important it is for workers to have that additional flexibility that allows them both to come in and earn and work for their employers while at the same time being able to take care of their families. And then I would just highlight that. So we ran a massive study in June, at the end of June 2021, asking people who were working and had dropped out of the labor force if they wanted to come back and start looking for work, and if so, when that would be. And we saw sort of encouraging signs. Again, this is before the Delta variant, so I think a lot of these dates are likely to be pushed back by 2 months. That's basically how I see the Delta variant impacting our jobs recovery. It's just a delay, not any sort of a long-term shift in the trend. So you can think about, the summer of next year as being really a time when we should have more people looking for work or working than were doing that prior to the start of the pandemic. And so the third and final section here is really going to try to address this issue of labor market dynamics, wages, job switching. I showed that first slide at the beginning of the presentation that talked about the sort of record level of quits that we saw. What's that about? What's driving that? And how long is that likely to persist? I think the first thing I would say is that really across the income spectrum, we see employed workers. This is a monthly survey that we've run for the last, I think since April of 2020. We're asked 1,500 employed workers if they're expecting to experience a loss of pay or income in the next 4 weeks. So it's essentially a question of job security. And over the course of the pandemic, that job security, I should say, has increased, or job insecurity has decreased, particularly most recently for low-income workers. So if you go back and you look at that November, December time period of 2020, even those people who were working in that period of time, a high share of them expected that they would somehow either be fired or have their hours cut. And that was not the case with the Delta variant. That over the course of June, July, August, September, October, we continue to see this downward trend in pay loss expectations. Again, signaling that there's increased job security among those who are currently working. And not surprisingly, that's driven an increase in employed workers who are actively going out and looking for work. Again, we hear all the story about job openings, record high job openings, and what Morning Consult can provide, or the insight we provide, is that not only are there record job openings, we've got an increasing share of people who are working currently who are also at the same time actively applying for new positions. So again, you can think about workers having an increasing level of job security, and they're saying, you know what, given this job security, maybe I can do better. I've somehow managed to be employed over the course of the pandemic. That's a really valuable skill set. I've demonstrated to my boss or my management team that I can provide value even in this period of sort of crazy uncertainty. Maybe I should go out and look for something that fits my needs, or that pays me even more. And in particular, we see that urban workers do this to a greater extent than suburban and rural workers. So part of that I think is a function of the ease of switching jobs within an urban area. But then of course we also just have more companies located, more economic activity essentially concentrated in these urban areas that makes the switching costs lower for urban people. What's interesting though is if you supplement that or complement this insight on the left-hand side with what we see on the right-hand side, which is asking people who are currently working, how willing would you be to leave your current state to go find work? We overwhelmingly see that urban workers are more willing to do that than their suburban and rural counterparts, suggesting there's sort of something unique about the, probably what drives people to move into urban areas is having fairly career-focused lives. And so those people are also more willing to pack up and leave to continue to pursue career prospects. If we look at this by industry and we start trying to understand, well, where do we see people really wanting, actively applying for work? What jumps out in our data is the share of technology workers who over the last 3 or 4 months have started to actively apply for work. Well before the general population, we started seeing this trend in the general population. And if you go back even further in time and start comparing it to what we saw in September of 2020, it's interesting because at that point in time, there was sort of this, there was sort of a back and forth between technology workers and food and beverage workers. Food and beverage workers, initially a higher share of them wanted to go out and leave because they were being fired like crazy and they were desperate to go try to figure out where else they could work. At this point in time, those food and beverage workers feel a little bit more job security. The technology workers, I think, are seeing that we're living increasingly in a world that's being driven by technology, that all companies have had to adapt to this, doing business in a pandemic environment where there's going to be, where an increasing share of work is going to be conducted virtually. And it's provided those technology workers with added incentive to go out and apply for additional jobs and see if they're able to find something more valuable or paying higher from their current position. And in fact, when you sort of put this in context, we do see that job switchers are making more money, or I should say they're experiencing faster wage growth than folks who are staying in their jobs. And that's not always the case. So this data is from the Atlanta Fed. They have the median, what they call their median wage tracker. And so it's a way of tracking wages over time while eliminating some of the outliers. And if you look at, historically, yes, job switchers, these are people who tend to be sort of high talent, more ambitious people. Yeah, their wage growth tends to be higher than folks who are staying in their jobs. But that difference is not constant over time. And in particular, when you have sort of periods of recession, so you can go back and look at this 2008, 2009 period of time where there's essentially a convergence in wage growth. That convergence ended in 2010 over the course of the recovery, and we started to see a divergence. And so in many ways, what we're seeing here, this bounce back in wage growth among job switchers is getting people back to where they were, their sort of steady state wage growth prior to the start of the pandemic, which was closer really to somewhere above 4%. Then I want to conclude by just sort of speaking a little bit about what we know about wage expectations. And so we asked, I mentioned this earlier, we asked 5,000 people at the end of June, detailed questions around labor force participation, their wage expectations and things like that. And so among workers who were not working at the end of June, but they were working prior to the start of the pandemic, what was it? Were they expecting wage increases when and if they were able to go back to work? And by and large, we don't see, a dramatic share of people who are expecting wage increases. We see here among all adults, 32% of people said 32% of unemployed workers who lost their jobs during the pandemic said they expected to make more, but we have the lion's share, 68% of workers here who said they were expect to make less or about the same. So I don't think reducing this story to one of wages and a mismatch, let's say, between what people are being offered and wage expectations accounts for the entire story. We also see that respondents really, even if they're staying with, respondents who were able to stay with their employer, the lion's share of them did not experience wage increases over the course of the pandemic. I think, you know, you've got a lot of people, right, who've been let go. Among those people who stayed on and they were able to keep their jobs over the course of the pandemic, roughly 60% of them, 55% said they're making about the same that they were as they were prior to the pandemic, with 20% saying that their wages decreased somewhat. And so I think to say that wages across the income spectrum or wages across the board are higher than they were prior to the pandemic sort of misses this nuance that for some workers, in fact, for the lion's share of workers, their wages haven't increased. And then, you know, I do think that adding in some of that, understanding the diversity of experiences among workers is really important. And we see here that factory workers in particular and folks working in stores are much more likely to say that they expect to be paid more as a result of the pandemic than they were prior to the pandemic. And again, I think this speaks directly to this issue of workers trying to make decisions given this high level of uncertainty. So there are certain risks that workers take on as a result of working directly with customers, particularly in a pandemic environment. And what we see is that they're asking to be compensated for those risks. Additionally, you've got people who are working from home, you know, who are now, you know, I'm sorry, before the, my apologies, before the start of the pandemic, people who were working in an office, and now most of those have spent a fair amount of time working at home, that transition from working in an office to working from home has essentially provided them with a non-monetary form of compensation, which is why I think why so few of them are expecting wage increases going forward. And then among the people, you know, again, at the very beginning of this presentation, I showed a slide showing that quits as a share of total separations, that was an increasing share of total separations, in particular over the last 5 months. And what we see here is that among people who are quitting their job, a lot of them are citing some desire, not just for more pay, but they're trying to figure out how to switch industries, how to figure out where they are more likely to have a stable, productive career following the pandemic. Oh, I think I jumped one ahead. And then I'm going to conclude here by talking, I think it maybe is a little odd for folks to think about productivity in the context of wages, but we know that over very long periods of time, wage growth tends to be driven by productivity growth. And so thinking about how the pandemic is likely to impact workers' productivity tells us a lot about where wage growth is likely to occur over the next, you know, a slightly longer time horizon, let's say 5 to 10 years. We see that in general, people are, you know, roughly half of people are doing about the same amount of work now as they were prior to the start of the pandemic. But younger workers are really feel as if they are more productive now than they were prior to the start of the pandemic. Again, I think a lot of that has to do with the ease of them diving in and working in a remote environment that's more technologically driven. And I think they've sort of adapted sooner to this hybrid work model, whereas older workers maybe are a little bit more set in their ways. And it's not just age that matters. I think skills and education as a proxy for skills is important here too, that these folks with more education, postgraduate degrees, that a very high share of them, and a growing share for that matter, said over the course of 2020 through March of 2021, said that they were getting more done in a day during the coronavirus pandemic than they were prior to the start of the pandemic. Again, signaling that these people who are working in jobs that are easy to, you know, where it's easy for them to work from home, they are provided or afforded additional flexibility in terms of how they allocate their time, their ability to deal with their family obligations while also addressing their work commitments, that form of productivity and flexibility is likely to drive wage growth for those higher higher educated workers. And so I'm going to conclude here slightly early, but with 3 points. So the first is just talking about looking at spending as an indication of demand for workers. So while aggregate spending is returning back to where it was before the start of the pandemic, how people spend their money, the allocation of spending has changed over time. And that says a lot about, or it introduces a high degree of uncertainty for workers trying to figure out which industries or jobs are most likely to be sustainable and stable as we emerge from the pandemic. I think we see a lot of very positive signs when it comes to attracting workers. So in general, I think attracting workers is going to be easier. We have more people who are looking for work, in large part because companies, consumers, the economy as a whole is doing better at managing the impact of these case surges on economic activity. So it decreases the degree of uncertainty that workers feel when they go out and start applying. But on the flip side, I think retention is actually going to become more difficult. So employed workers who are out there, they're experiencing on a day-to-day basis these wage dynamics or labor market dynamics. They have an intimate awareness of what's going on. They increasingly are looking for better opportunities, and I think those opportunities, a lot of that, of course, has to do with wages, but not all of it. And we see, as we saw in our data, so much of it has to do with additional flexibility and the ability not only to do your job, but to maintain all of your additional non-work obligations. So Caitlin, with that, I will end it, and I'm happy to take questions.
Awesome. Well, thank you so much, John. Yep, we have 3 questions that have come in. Well, 3. There are 2 sets of them, but I think these first 2 can be broken up. How are higher wages a lasting legacy of, are higher wages a lasting legacy of the pandemic? And in that same note, how has workers' bargaining power changed as a result of the pandemic?
Yeah, so I think higher wages are certainly a function of the pandemic and a lasting legacy of the pandemic. I think it's unclear if wage growth or elevated wage growth is going to be a lasting legacy. So wages in general tend to be very, they show a lot of what they call downward rigidity. So it's really easy to raise wages, very difficult to lower them. So all the wage benefits that workers have experienced are unlikely to reverse themselves. I don't see that rate of wage growth continuing or accelerating in the future, particularly as more and more workers start entering the workforce. In terms of wage bargaining power, I think that's a really tricky question. Right now, we're at a point, again, where there's remained so many workers who are on the sidelines that I think it's a little premature to say that workers necessarily have more bargaining power. And my guess is that as workers on the sidelines feel increasingly comfortable coming in and applying for positions, we'll see that exert downward pressure on wage growth, and I'm guessing wage bargaining power as well.
Fair point. And then the last question we have, what role does the skills gap play in explaining the record level of open positions? In other words, is the problem that the US lacks workers with the right skills for the jobs that are currently available?
My short answer to that question is no. I don't think it's really about the skills gap. What I tried to highlight in this presentation is the role that uncertainty is playing in preventing workers from going out and looking for jobs. That it's not just about, and I think more broadly, when you say this, when people talk about a skills gap, it assumes that the skills that companies need right now are also the skills that the economy as a whole is going to need 2 years from now. And I just don't think that we can definitively say that that's all set in stone. I continue to believe, particularly as consumers change their purchasing patterns, that that businesses are going to require different types of skills over the next few years, and that it's really about that sort of uncertainty or the evolving nature of our need for different types of workers that's limiting people from coming in and taking positions.
Awesome. Well, no other questions have come in. So John, thank you so much for your time today. Thank you to Morning Consult for letting you come on and do this. I think this is a lot of great information, and really, gives you power behind moves and decisions. So thank you so much. And everybody that was able to join us today, thank you so much for investing in your education here with the IFA. There are 2 webinars remaining in this series. The next one is on November 10th, and it will be around hiring and attracting new talent. So make sure to on community.franchise.org is where you can sign up for that. All right, John, thank you so much again. Everybody else, stay safe. Have a great day. Thank you so much.
My pleasure. Thank you.